Welcome back to the channel. And if you're listening on the podcast, welcome back. We're glad to have you. Well, the Christmas season is now upon us, and that means there's a lot of things that we're probably all planning for, presents to buy for people, decorations, all that fun stuff to take care of. But in the midst of all this hecticness and busyness that happens around this time of year, it's oftentimes easy to forget about there may be some things that you can do to possibly put yourself in a better financial situation when it comes to your retirement. And I'm specifically talking about things that have a deadline attached to them, very specifically talking about tax issues. Because from the tax man's perspective, it's not really Christmas time, it's almost the end of the year. December 31st is a deadline for a lot of things that have to be done if you want to count them as being done for your tax return that you'll file in April for this year of 2023. So in today's episode, we're going to go over a couple of things that you might want to consider for your own financial situation that might make sense to look into and do before the deadline passes. So let's just jump right into it. The first one is qualified plan contributions. If you are an employee who has an employer that offers you a 401k, or if you work for a government employee, you might have access to a TSP. These employer-sponsored plans, you have until the end of the year to make any contributions that you're wanting to make into those accounts, up to your max that you can do for the year. Now, the deadline, of course, being December 31st for the year, but for qualified plan contributions, employee contributions, the official deadline might be December 31st, but for all practical purposes, for you, it's going to be whatever day your last paycheck falls on. So once that last paycheck happens for the year, you're not really going to be making any more contributions. So if you need to alter that, look into doing that before the deadline or before it gets later in the month. And that's why this is the first video and podcast of December that I'm putting out, because there's still a little bit of time left over that you can make some changes. Also, qualified plan distributions. If you are going to be making any distributions from your IRA, your 401k, your Roth IRA, whatever it is, you have that deadline of December 31st for those distributions to count for the year of 2023. And just for this year, the last business day of this year is going to be on December 29th, which is on a Friday. So really, that's your last day. So if you're looking at doing things like taking some money out of your traditional IRA because you've looked and seen that you're in a favorable tax bracket, or it just makes sense to pull it out and claim it as income in the year 2023, then make sure that you get that taken care of before the last business day of the year, which is Friday, December 29th. Also, the end of December is the deadline for doing Roth conversions if you want those to count for the year 2023 as well. Again, that same deadline, Friday, December 29th is going to apply for this because that's the last business day of the year. So if you're wanting to do any Roth conversions, which if you're familiar with this channel and listen to my podcast a lot, I talk about these a lot. But if you're not familiar with what a Roth conversion is, it's essentially where you take your traditional IRA and you can take a portion of that or all of it, but usually, you'll want to do this over a number of years, where you take a portion of it and you go ahead and convert it, roll it over into a Roth IRA, and you claim it as income for that year. So you pay the tax and get the tax man off your back permanently at that point. And then everything that Roth IRA grows to going forward is all tax-free. Now, the deadline to have it happen for this year would be the last day of the year, or as I said before, the last business day. Now, why would you want to do this? if you were looking and looking at your numbers, how much income you've brought in for the year, and you've put some pen to paper and found out that you're in a favorable tax bracket, you may want to go ahead and just claim some of the income on a Roth conversion and transfer some of those funds over to that. Claim it as income, pay the tax on it when you're doing your taxes at the beginning of next year. But your deadline for it to count on a conversion is the end of this year. Once December 31st is passed, any Roth conversion that you do from that point would count for the next year. So that deadline is coming up. Same thing with required minimum distributions. If you have an account that requires you to take distributions from it, like a traditional IRA or 401k, then you want to make sure that you get those taken care of before the year end as well. And this is not just for your traditional IRA. Once you've reached the age, right now it's age 73 is when people have to begin taking the required minimum distributions, but also for inherited IRA accounts as well. If you have any distributions that have to come off of those, also make sure you get those taken care of before the year end as well. You don't want to have to pay a penalty on that. Another one is tax loss harvesting or tax gain harvesting. So I think a lot of people are familiar with the phrase tax loss harvesting. And what that is when you take an account, we would call it a non-qualified account, which is just a way of saying it's not inside an IRA. It's not inside an employer-sponsored retirement account. It's just money. You've got a brokerage account. Anytime you get dividends or interest off of it, you pay claim that as income every year and pay taxes on it. Or anytime you sell a stock position or a bond or a mutual fund position inside that account, you're going to either claim a gain or a loss on that sale. So this time of year, once you have the deadline of the end of year, if you have any losses that you're wanting to harvest, because you can harvest losses and use those losses to offset income that you have in other areas. So if you want to do that for 2023, then you have to do that before the year passes. But another thing that you can do is also called tax gain harvesting. Now, this is something that works out if your income is very low already. Maybe you're retired and your income is lower than it used to be, and you may find yourself in a very favorable capital gain tax bracket. You may be even in the 0% capital gain tax bracket. This is for long-term holding. So if you've held a stock or a mutual fund or an ETF or whatever it is, and you've held it for over 12 months, that means it's being held long-term as far as the tax IRS is concerned. And if that's the case, you may then fall into a favorable tax bracket on your capital gains. And so capital gain harvesting would be where you've got a gain in a position, it's grown over time like you would want any investment to do, and you look and you say, I could sell some of these stocks, claim the gain, and I'll be in a favorable tax bracket still if you've run your numbers on what your income is looking like for the year 2023. And then you essentially have a very favorable low taxation on that gain. That would be tax gain harvesting. So not as well known or talked about as much as tax loss harvesting, but it's another way that you can use the tax code to your advantage. So that would be another thing to do. And the deadline of that is, of course, the end of the year as well. Also, another one would be charitable donations. So if you are charitably inclined and you have funds that you want to provide to a charity, you want to make sure that those donations are done before year end. Now, something to keep in mind with this, that charitable donations, you can write those off if you itemize your deductions. So if a lot of people now, especially after the Tax Cuts and Jobs Act, the standard deduction that you can deduct off of your adjusted gross income is a lot higher than it used to be. So less people now are itemizing deductions. It doesn't make as much sense to do that now if your standard deduction is more than your itemized deductions. But if you are in a situation where you do itemize your deductions and you're able and you have enough deductions from, let's say, state and local taxes that you can write off, or medical expenses, or charitable contributions that you've made for the year, it might make sense to itemize your deductions. Well, if you do that, then that's where it comes in handy to remember you have until the end of the year to make more charitable donations. If you take the standard deduction, though, like most Americans are probably doing nowadays, you don't get to write off charitable donations like on top of the standard deduction that comes out anyway. So if you itemize, keep that in mind. And especially keep it in mind that you do not want to wait until the end of December to do all of these things and to look into them. That's why this is the first video. This is the first podcast episode coming out for the month of December, because you don't want to wait till the last minute to do this, because you may not get it processed in time. The custodians where you hold your funds, they may not process that required distribution in time if you wait until December 29th to make it like 5 minutes before business hours are over. So make sure that you don't wait until the end of December when you're doing all of these things. And as always, if you are looking for additional help on planning for your retirement, feel free to head on over to my website, retirementplanningmadeeasy.com. You can download a free copy of our essential step-by-step retirement guide. That's all I got for you today. I'll see you guys on the next video and the next podcast.